Hi, everybody. Jared and Chris here with Beyond Capital. Good to see you all. We're going to talk about one specific thing that we've got to see for the stock market to bottom. So, in today's video, we're going to talk about that. There's a lot of news, there's a lot of noise. We're gonna really focus it down to one thing. So, stay tuned, and we'll talk about it. All right, welcome back, everybody. Let's dive into this. I think I
One
think
thing,
the
Jared.
I, I,
One
I
thing.
I think one thing is great. I'm a single track kind of person, and I just want to know what is that thing. And I think there is a pretty accurate thing. What do you think?
I do. What's funny is, we intro and it's like one thing. Well, right now, if you're a trader, investor, if you're watching any mainstream media, it seems like there's an infinite amount of things. There's the Fed, there's China, there's US, there's oil, there's you name it. It's somewhere out there that's like creating all this division, all this uncertainty. Nobody knows what's going to happen. But today we are here to say it's one thing. We finally, after all the confusion, it's one thing that we're watching. And it is drum roll, Jared, take it. What is it?
Drum roll, drum roll. Let's talk about that one thing. We've got a good chart up here. You've probably heard it. You've probably seen it floating around the internet, Twitter, and so on. But it's really simple, right? It's right here. You can see I've got a chart. This blue line that you see on the top there, that's the S&P. The orange line represents one of the yields, right? And this is in this specific example, we're looking at the 2-year yields. Now, you hear a lot of talk about the 3 month, the 1 year, the 2 year, the 5 year, the 10 year. Honestly, they all have slightly different implications in the market, but I think generally speaking, pick a yield, any yield. Yields
This year
have to go
especially.
down. Yeah,
This year
especially
especially.
this year where
Yep.
where we've seen historic low yields for so long. It's been
Mhm.
so long. And so I think you could pick most any yield. You want to pick a 2 year, you want to pick a 10 year, go for it.
You
But
can do no
we
wrong.
you
Pick a
can do
yield.
no wrong picking a yield.
Yeah,
But we have got to see yields start to bottom out, or excuse me, top out before the stock market can start to bottom out.
correct. So let's use that chart, Jared. Let's go back and see just in time how they're and again, they're not perfectly correlated. So you'll see that when we start to see the S&P rally at the left side of the chart, that nice little run post 2008, 2009, stock market bottoms, we start to see that the S&P is going up and the yields continue to go down. We start to see there's some sideways movement back in 2015 in the S&P, yields start to go up. We start to see that as yields were rising in 2018, we had some sideways movement in the S&P. We were actually talking about this before the recording. 2017, the S&P had 12 bullish months in a row. Never had a losing month.
That's
Okay.
amazing. I love that.
And then we go into 2018. I think we only had two of 12 losing months. And the two happened to be monster losses. Like December of 2018 was a monster dump in the market where the S&P dropped 20%. And you can see that little dip where that horizontal or that vertical line is, that dip in the S&P, it doesn't look like much, but that's over 20% in a very short amount of time. And you can see that the yields were up. The yields were rising, rising, rising. And that's what gave, really kind of helped support that giant drop. And then we had some, broadening formations and high volatility from 2018-19. Then you have your COVID crash, and here we are, 2022. What is that? What is that time? It was like August or so when yields started to rally, and then the stock market around
Yep.
November, December started to top out.
I think it's important to note there's a couple of factors here, right?
Hmm.
Number one, some of these movements in the stock market look pretty minor, right? Like
They're
you said,
not.
this
Those are
this is
all significant.
2018.
Yeah,
Yeah, that's a 20% sell off. This
yep,
right here is COVID, right?
30%. Yep, 30
Now,
plus
when
percent.
we see, I think two important points to bring up here. When we see big shock factors in the stock market, we'll see a big shock factor in yields as well,
Hmm.
right? We
Hmm.
saw 2008 back here. Stocks sell off hard, yields go down hard, right? But then things calm, and we start to see this pattern and this correlation begin once again, right? So here's the bottom, essentially the bottom of the stock market, which was, February, March of 2009. But
Hmm.
yields had kind of made a big move, a couple of months before. And we kind of have this, I would say, kind of like a 2 to 4 month kind of window when yields really start changing direction. it's about 2 to 4 months before the stock market starts to react to that, right?
Right.
So,
Right.
so this is a great example over here. We saw yields, essentially not doing too much. They start to kind of work their way up, but we really see kind of a run on yields, August 2017, right? And they start
Hmm.
to go up and up and up. But we see the stock market essentially top out January 2018, right?
Hmm.
So we have this kind of August, September to January window, in yields in the stock market. Yields are going up, the stock market tops out. And like you said, we have this really choppy sideways 2018, followed by, yields continuing to go higher. Yields topped out here at about October 2018. And the stock market was just, coming down hot by then. Now the
Right.
stock market bottoms out about the end of December 2018, but yields had already started to go down,
Down.
and we
Yep.
start to see stocks recover and work their way up, and yields go down.
Yep.
So same thing right here. We see after COVID, rates, emergency cuts, everything's down to zero. We see 2-year yields at about 1/4%, or even less than 1/4%.
Hmm.
And it takes a little while, right? It takes a little while. It takes a couple of months, and we start to see, end of summer, we of 2021, we start to see yields creeping. They're creeping. They're creeping.
Hmm.
The stock market's still, for the most part, doing pretty darn good. And then, of course, we see the S&P top out in about January of 22, and yields had already started working their way up, and yields have just gone straight up since, and the stock market has gone straight down since. So the
Yep.
important thing, one of the important things to remember is that lag time, right? So if
Hmm.
we need to see yields turn here to start bottoming stocks out, if yields turn today, if we say, okay, this is the high in the 2-year yield
Hmm.
today, it could take 2 to 4 months for the
Right.
stock market to officially bottom. So that's what we need to see. We need to see yields top out and start to turn, and we need to see, and then we have to give this lead time in the stock market for stocks to react. So
Yeah.
because
Is
remember,
it
yields are kind of taking all that stuff into account. Yeah, go ahead.
Yeah, is it fair to say that, probably a 60 to 90-day window is appropriate? Kind of a
Yeah,
60, 90-day
60 to
window?
90 days, yeah, I mean, I think, yeah, I mean, this kind of 2 to 4 month window
Sure.
seems to kind of be what we see, right? We have a couple of
Mhm.
examples of yields turning in August and the stock market making a drastic turn in January, right?
Right,
So,
right,
4 months seems to kind of be the long run, and it seems like 2 months we've seen it happen, 60 days, within 60 days, but it's certainly not immediate. There's definitely a lag
right.
here. So
One thing I'd like to ask for you to include in this is, can we also, with an extra line on that chart, can we also include the DXY? I know it's gonna look very
Oh,
similar to the
oh,
yield line, but this is another correlation that I have been watching. I know we just, we're going against the grain here and said there's only one thing. This is the one thing that we should be watching. Watch the 2-year yield. When that starts to top out and starts to go lower, making lower highs, lower lows, we're getting much closer to the equities market finding its lows. So maybe it's, maybe it's within 30 days, maybe it's 60 to 90 days, maybe it's at 2 to 4 months. But traders and investors can be a little bit more excited about the light is at the end of the tunnel. We at least see a relief rally coming. And honestly, knowing that, we've talked about this before, there are hundreds of billions of dollars on the sidelines. There are trillions of dollars on the sidelines that would love to be reallocated and re-leveraged. And if we get that
yeah.
in that 2 to 4 month window, we will see a pretty healthy recovery. And whether this is in energy, whether this is in financials, whether this is technology, whether this is consumer defensives, whether this is in growth, we don't really know. But something will emerge victorious. And so if you bring up, so the blue line there, that little blue line is our DXY. Is that correct?
I would like to
So
call it the aqua line, but yes,
the
go
aqua
ahead.
line, yes, the teal, aqua, turquoise. So we'll you see the similarity, and again, that line doesn't really do it justice, because if we went to a DXY chart, we have been in an 18-month trend in the DXY. 18
let's
month. It started in January of 2021, so we are 18 months into this, and that thing has been parabolic, just like the yields have been in 2022.
I mean, it's pretty safe to say that yields and the dollar are gonna show kind of a similar picture, and this is kind of that thing that we're talking about, right? Like pick a yield, any yield. Pick the
Yeah.
dollar. The dollar has to turn, but the dollar will turn with yields. Yields will
Yes.
turn with the dollar, and
Yes.
all of that is going to incorporate the Fed. All this guesswork about what the Fed is doing, and I mean, as we've talked about many times, what the Fed, right? What
What
the
the
Fed.
Fed? What the Fed, man?
So there's all this guesswork, right? What's the Fed doing? Honestly, I have no idea, and I can't figure it out either. They're going to either raise rates forever until something breaks terribly, or they're going to stop raising rates, or whatever. But
Yeah.
guess what? Yields do a great job identifying that stuff for us. And
Very true.
and remember, yields will take a little bit of time, or the stock market will take a little bit of time to catch up to yields. But yields don't have to wait to turn because the Fed has said we're pausing, right,
Right.
or we're pivoting.
Right.
That's not what it's going to take to turn yields lower. What it
Right.
will take is that the market feels like it has a confident read on what the Fed is doing. Like the Fed
Correct.
is has when and if the Fed gets to this point where they say we have done all we can do, then yields say, okay, sniffing out 3 6 months in
Hmm.
this area, we're now confident enough about what the Fed is doing, and yields begin to turn. Right.
Yeah.
So we're still in the midst of a tightening cycle. And this is something that does not get talked about probably enough because we haven't had a tightening cycle for 12 or 14 years, whatever it's been, right? It's been so
Right.
long since we've had a legitimate tightening cycle. Yes, we've had a few little mini ones in 2019 and so on, but a real good legit tightening cycle like we're seeing right now where interest rates are getting ratcheted higher. I mean, we're
Hmm.
seeing 75 basis point hikes every 6 weeks. I mean, these are
Which
extreme hikes.
exactly. Don't I mean the ECB for the first time in 11 years raised rates. Oh my gosh, it's like breaking the eurozone. The dollar is expected to be at and again, this is what keeps moving right now is the Fed funds rate target keeps getting shifted where just last week we had CPI data and it came in a little bit hotter than expected and we're, dropping by 0.1%. It's like it's going to take 6 years to get down to 2% inflation at this pace. So
Yes,
instead, the market's pricing in okay, they're going to raise rates 75 basis points. They're going to raise rates again by another 75 basis points. And then they might do another 25 basis points. And then we have to wait and see what the Fed does. So the
right.
market, like you said, they're sniffing it out, but they're just not confident that that target has been fixed. That target keeps shifting. And until it stops and until the market is comfortable saying, look, this is where the top is in the Fed funds rate, then we're going to see the market continue to navigate these, potentially lower lows in equities and these higher highs in yields.
Yeah, yeah, exactly. And I think one thing to kind of think about as well is, when we go from rate hikes that are, if we go from 2 to 4%, that's doubling the interest rate. If we go from 0.25% to 4%, that's a massive hike, right? And so we're in a much more aggressive rate hike than we've seen in a really long time. We're going from such low rates to decently high rates. Now, if we were
Hmm.
coming from a medium kind of place to slightly higher rates, that's one thing. But we're going from next to zero rates, up to 4%, four and a half
Yeah.
percent. These are aggressive hikes.
In hindsight, it seems like everyone's caught off guard, but it's like that's. I mean, this is normal. I mean, we should be able to operate at 2.5, 3%. Our inflation target has been always 2% or has been talked about to be 2% or less. Um,
Yeah,
I mean, it's funny because during this whole growth cycle in the last 14 years, once we bottomed out in 2009, it was all about low interest rates and it's all about accommodation and it's all about preventing deflation and we're doing the complete opposite now because we're doing everything we can to throw the kitchen sink at preventing inflation. And again, it's a super messy situation and it's messy for the entire world. And again, rather than focusing on all that because it's tons of uncertainty and the Fed and central banks should not be fought right now. And if you're trying to call tops and bottoms, it's proving very difficult. What we're saying here is you can watch one really strong, very valid data point, and that is the 2 year yield. When that peaks and starts to make lower highs and lower lows, the dollar will probably do the same thing. And that within that window that we're looking at, because there's typically the yields will lead, then we'll look for the bottom in equities and we'll look for a decent rally and recovery.
that's right. That's right. And remember, we don't need to see the Feds, stopping, pausing, pivoting. We don't need to see any of that. We just need to know that the market needs to know that it has a clear read on the Fed. And right now, nobody has a clear read on anything because everything is out of sorts. But the Fed is still we're in this part of the tightening cycle that, we're probably 2/3 of the way through, 3/4 of the way through. But there needs to be a little more clear path ahead for yields to say, we recognize that, we feel comfortable with that, let's start adjusting accordingly.
Mhm.
So it's going to be interesting, but watch those charts. We wanted to give you just a quick video and say this is what we're watching. The rest of
Mhm.
it, I don't think is going to. Everything else will fall within the purview of what yields are doing. So watch
Yeah.
yields, save yourself, looking through a million charts and a million different things, and just say yields turn, the market bottoms. It takes there's a little lag time there. It takes a little bit of
Yeah.
time, but
It will take some
that's
time.
what we're
And
going to look at.
one more thing, I just want to add this. Is it possible, Jared, in your opinion, that when we see the yields top and start to make lower highs and lower lows, do you think the market may still face that capitulation phase where we might have an aggressive sell-off at the end in order to produce
Ooh,
that bottom? So
ooh, that's a
don't
good
think
point.
that with the yields going lower, that all of a sudden means like the bottom is coming. We might still have a violent sell-off, another capitulation lower, and then is the time. So I'm thinking about that because
That's
let's not get super aggressive on the lows yet, but it's like let's be ready. Let's be ready.
I think one thing to kind of think about here is we know that we've got all of the the aggressive economists and traders and hedge funders, the Michael Burry's out there, even Ray Dalio saying there's going to be another painful dip, and that might be the capitulation dip. Everyone, we've been hearing a lot of capitulation talk and bottoming and so on, and maybe we haven't seen that yet. So that's a good point. Watch for capitulation.
Yeah.
Watch for that aggressive bottom. Watch those yields and be careful.
Fingers crossed. Please
Fingers
just be
crossed.
one thing. Please just be one
I,
thing.
I found one of my favorite trading strategies is hope. So
Yeah.
that's worked
It's
out
certainly
for
better than burying your head in the sand.
that's true. That's true. At least
It's
we're.
one step above that.
I mean, it's parallel, but we'll
Yeah. What is that saying? Hope in one hand and something in the other? Yeah, we
see which
know.
one fills up first.
Yeah. No, but in all
uh,
seriousness, I think this is a really straightforward way to look at what is valid, what the market is probably using. And when you look back when it settles in and the yields start to drop and the equity market starts to bottom, everything we're talking about is probably valid. So, again, to keep it simple, rather than getting bombarded with headline news that's confusing and it's super bullish and it's super bearish, you're making this case. Like right now, Jared, I'm reading a lot of stuff on just short term bounces. Technically, the market's at a bottom. Technically, this, it's like, man, it's no different than reading the market's going to go down another 19%. Here's one more thing for you. Fun fact. For the last 70 years, the average bear market in the S&P is around 28 to 30%. The final 20% of that has always occurred in the final 3 months. So the most
mm,
violent selling is usually at the end. So that's why I just said,
uh,
like, maybe that capitulation, we might have another chunk lower. And if so, it could be a violent chunk lower. So just think about that. So if the market does drop another 10, 15, 20%, what does that do? Are you ready for that? Can you brace for that? Are you prepared for that? And if so, then you're fine. But if that's going to be throwing, I don't know, a turd in the punch bowl, then you might want to think about some strategies that help you alleviate some of that trouble.
yep. Think about lightening up the portfolio a little bit. Maybe having some option exposure instead of
Mhm.
stock exposure, and just play it careful. The only thing I think any of us can do right now is be defensive,
Very much.
stay, take care of your account so it can handle if there is a violent capitulatory bottom, that you're going to be okay and you're going to survive it. That's all we have to do right now is just
Yep.
survive, because there will be plenty of money to be made on the recovery on after the bottom, but got to stay alive, got to hang in there,
Yeah.
keep the gloves up, do it. Thanks everybody. Leave comments below. Tell us how. Tell us what your glove putting on strategy is. We
That's
want to
right.
hear
Or
it.
what's the one thing you're watching? Tell us. What's the one thing you're watching? Are we off base? You think it's something else? Should we watch, Biden's tweets? I don't know. You tell us. What should we be watching?
Let us know.
All
Let
right.
us.
Thanks for watching, everybody.
Take care, guys. Good luck.